All right, so we're right at 9 o'clock. I'd like to go ahead and get started and make sure we take advantage of all of Russell's valuable insights today. So good morning, everyone. Welcome to Equinox Business Law Group's May Focus event, the 5 levers of cash management and profitability. We're really excited to have you here, and this is an important topic, not only right now where we are struggling in a lot of cases with how to figure out cash and profit in our businesses, but it's an important topic every day in business. So we're excited to have Russell and Stride participate and share their insights for us today. For those of you who are new to Equinox, we are a business law firm that offers a general counsel model. We take a business first approach, really enabling the business owners to do their best work while we handle kind of all things legal in the background. We do these monthly focus events for our clients and guests in order to bring forward, topics of interest, hopefully things that are really timely and valuable for your business. At the end of the program, we'll highlight some of the upcoming programs, but it's a really great way to get folks together to learn new things as well as refreshers on old things. A little bit of logistics for today. We are recording the program, so the link will be available to you afterwards. That way you'll be able to go back and hear this again and catch those things you might not have been able to write down. And if you have questions during the program, please use the Q&A button at the bottom of the screen. We will try to answer those either real time or at the end. And if we aren't able to do so, we'll ask Russell to give us a little bit of information about that we can include in the follow-up email with the webinar link. So with that, I'd like to turn this over to Russell Benaroya, who's one of the owners of Stride, which provides outsourced bookkeeping and accounting services. They are really focused on building businesses, growing them, and this is one of the core tools of cash management and profitability for your business to use. So welcome, Russell, and I'll hand it over to you.
The number of times that I have started a webinar and been on mute are immeasurable. Can I please confirm that I am not on mute right now? Thumbs up.
You are not on mute.
Michelle, I'm not on mute, am I? Okay, well, good. That is a good first start. And please do not be distracted by the robot pillow that's over my right shoulder. But it's very apropos because we are talking about building the machinery of your business today around cash flow management and profitability. So meet my robot pillow. Thank you all for having me here today. It is a pleasure to spend time with you, to partner with you, to support you during this particular moment in time. I know somebody will be managing the chat as you have questions, and I'm going to do my best to answer any and all that I can. If I've realized anything over the last 2 months, it's that the warmth and the camaraderie and the collaboration with which we come together to support each other is what truly matters. And so it's a gift to be here. Michelle, you gave a bit of an introduction on Equinox. Let me just double down on Equinox for a second, because you and I have worked together in the past. Equinox is clearly not your everyday law firm. I mean, heck, they're calling a guy like me to be on a webinar for accounting and finance, right? Like that's not sort of your typical MO, but what makes them special is that they're not just partners in name, but they're clearly partners in action as well. They help you run your business. So think of them as like general counsel on a subscription basis. Typically, I go to attorneys when something has gone wrong, but I think what Equinox does a particularly good job is helping avoid things going wrong in the first place. So thank you for that prevention, and thanks for having me here today. Okay. Let's rock and roll. Okay, of course there are a lot of things to be concerned about right now. Getting toilet paper was one of them. Maybe it's not. I mean, the shelves are still a little light. But just as a complete aside, before we even talk about why we're here today, there's a very rational explanation for this phenomenon in behavioral science and behavioral economics. So 3 things I want you to know about this picture of accessing toilet paper, which do have a relation to what we'll talk about today. So one is there's a behavioral economic concept called the bandwagon effect. We're comfortable following the crowd. Empty shelves are evidence of what others are doing. And so we want to buy more. So the bandwagon effect. Number two is scarcity. We get scared when things feel scarce and we hoard. So even if we don't need the toilet paper, we grab the toilet paper. And the third is loss aversion. We experience loss much more keenly than the equivalent gain. We don't want to lose the opportunity to purchase it if it's available right now. So why does this even matter? Because fundamentally, we are driven in life by three things: approval, security, and control. And we know through research that we tend to lose IQ points. In fact, our IQ goes down 13 points when we're scared. Today is an opportunity to get some level of control so that the very real behavioral elements don't creep in and have us making suboptimal decisions about our business in a time of uncertainty. So getting a handle on our levers today to make better business decisions is directly related to why you're grabbing toilet paper at Target or Costco, or hoarding it in some cases. Okay, so speaking of levers, having some control of the levers of your engine or your machine is what breeds confidence. And I'm not looking for you to be this guy today. But some of you may be, and that's cool. I mean, I kind of am this guy. I don't carry an abacus anymore. But what I'm really talking about here is the confidence for you as a business owner or a business leader or a business executive to show up on the main stage and execute every day with more conviction and with more confidence, because we have a choice. We have a choice every day for how we're going to show up. We have a choice for what story we're going to tell ourselves about our own control, our own security, our own approval. The choice you all made today to get on this call has nothing to do with accounting and finance and has everything to do with your continued relentless desire to build and manage the machine that is your business. My name is Russell Benaroya. I tend to show up in a few different ways. Today, I'm going to show up as a buttoned up accounting and finance guy who owns a virtual back office bookkeeping and accounting firm called Stride. I've also been a cool guy, startup entrepreneur through a few startups. And I've also been, I'm not really sure what I'd call that guy, but I think the point is that we're all complex individuals. I'll show up as guy number one today. And speaking of complexity, I think it is inside of our head that throws us around incessantly, because remember, as business leaders, we really want to be focused on growth of our business, ideally, and innovation in our product and service. But there's this little ball, right, of stress in our life. Certainly, we all have it, but certainly as business owners, we have a lot of it. And it shows up in fear and family and payroll and cash flow and self-doubt and capital constraints. And it's kind of like we're sitting in an idling car that is, our foot's on the gas and it just never lets up. And when that happens, right, we suffer all of these elements that I'm sure many of you can empathize with. And that stress signal, especially in a time like today, tends to be a vicious spiral. And I'd like to contribute to stopping that right now, or at least a little bit, or hold it for a moment and let's see what we can unlock to reduce some of that stress by not forcing you to master everything today, but by helping you understand what are the questions that I want to be asking the people that are around me about how to maximize the machine that is my business as measured by cash flow and profitability. So like I said, today has very little to do with accounting and finance and has everything to do with the tools to take control and everything to do with your freedom. So let's rock and roll. I've got some things. We're going to go through things. They're going to be fairly fundamental because we don't have a lot of time. I'm happy to go into any level of detail, but I want to fly at an altitude that's high enough to grasp and take action and move quickly. Remember, your financials are both a scorecard for your business and a gateway to making better decisions. And also remember that independent of your environment, the ups and the downs and the unknowns, the value you are creating in your business is measured by the present value of your future cash flows. That's how businesses are valued. So it reasons that your energy, your time is focused on building a cash generator to create value. The more you know about the levers of your cash, the more likely it is you will create long-term value on this journey. And the concept doesn't change in any environment. The question is, how do you change when the environment changes? And staying attuned enough to it to say and acknowledge, environment has changed, embrace reality, deal with it. How do we need to modify? Warning, there is a little bit of math. It's not complicated. A little bit of addition, a little bit of subtraction. I can simply not get away from a little bit of math today, but I'm going to keep it fairly simple. I want to start off by just clarifying an accounting term that some of you may say, oh my gosh, really? We're really talking about this? But yes, we are going to talk about this two particular terms, because even after I've been in this for 25 plus years, it's nice to have the reminder. So let's go there. Accrual versus cash. Accrual versus cash accounting. Many of you operate businesses or are involved in businesses where you account on an accrual basis. And an accrual basis means that you record revenue and expenses when they are incurred, not when cash is exchanged. So if I deliver services for you in a given month, and I bill you, but do not get paid because you're so slow to pay me for 2 months, I'm still recognizing that revenue in the month that the services were performed. And oh, by the way, if I had some expenses against that revenue, like, I don't know, particular personnel, I'm making sure that I'm recognizing that expense in the month that I generated that revenue, not in the month when I necessarily paid the individual. Okay, so there's some real pros to this concept, by the way, but cons too. So the pros are, one, it reduces variability, right? When you're matching and you're more consistent about matching expenses with revenue, it will reduce the invariable ups and downs of, well, when did I get the cash? Did I get the cash? Am I going to get the cash? It really shows you and others around you, lenders, investors, partners, true profitability of your business. Banks and investors, they like it. It's hard to fudge. It's hard to fudge. Cons, though, it's hard to see what the cash impact is. Did I collect cash or didn't I collect cash? Like, I could generate a ton of revenue and not collect cash. Problem. So it's a little more intense to manage. A lot of journal entries, unsexy accounting stuff going on. Okay, and then there's cash accounting. Cash, simple. I record it when it's received. I got paid, I recognize revenue. Cash went out, I recognize the expense. So here are the pros, right? Super simple. It can be pretty tax efficient because you can game it a little bit, like, oh, don't pay me right now. Pay me next month or after the end of the year. And for companies that don't have inventory, because inventory creates a lot of complexity, it can be particularly helpful. Cons, a lot of variability. So you look at your profit and loss statement, your income statement, you're like, I don't know, like, am I profitable? Like I was last month because I got a ton of cash, but I'm not this next month because nobody paid me, but I still had to pay my employees. So it's difficult to assess true profit. I'm going to throw out these terms a couple of times, accrual versus cash accounting, and forgive me if this is redundant for you, but always worth reinforcing. And a good way to do it is with a simple example. So, right, simple table here. I sent out an invoice for $5,000 for a web design project that I completed this month. So in And I received a bill, right, for $1,000 in developer fees for work that I did this month. I paid $75 in fees for a bill that I received. I also received $1,000 from a client for a project that was invoiced last month. If we were in a room together, and if I was way more savvy on Zoom webinar, I'd be like, please raise your hand, share, what do you think? I'm just not quite there yet, so I'll reveal. So the reveal is, in an accrual world, I sent out an invoice for $5,000 for a web design project. I'm going to recognize that revenue of $5,000. I received a bill for $1,000 in developer fees for work that I did this month. I'm going to recognize the expense. I have profit of $4,000. Cool. In an accrual world. Has nothing to do with when I received the cash. It has everything to do with when the work was performed or the expense was incurred. In a cash world, right, well, I recognize revenue because I got that $1,000 from a client for a project that was invoiced last month. And I paid $75 in fees for a bill that I received last month. My profit, $925. Same business, way different bottom line. What gives you a truer picture of the company's profitability? It is accrual. But the point is that profit and cash are two very different things. Profit and cash flow are two very different things. Capiche? We get it? I'm looking for nods. I can't even see you. Hopefully you're nodding. Okay. So let's now translate this into some plain English speak where there's a little bit of math. I want to use an example. I made up this company. They're pretty successful. I didn't have to do much other than put some numbers in the spreadsheet. But this company, Blast, is a marketing services firm. They sell marketing projects. You probably aren't a marketing firm on this call. Maybe you are, I don't know. But you probably sell other professional services or sell experiences or sell software. It doesn't matter. Because there are three universal things that do matter and are important to discuss. The first is understanding the concept of unit economics. You are probably the largest investor in your business, or the amount of time that you spend in the business that you work for is probably the most amount of time that you spend on anything else in your life. The unit, the economics of the thing that you sell is so critical, but so misunderstood. We'll dig into that. Second, I want you to understand the difference between cash versus profit, and we'll go through that in the example. And I also want to share some thoughts around the cash conversion cycle. How quickly you collect cash once you've performed services, and when you pay out cash based on services that you've received. So prepare. Plain English, unit economics, and profit. Okay, so plain English here. I'm a company, I sell marketing projects. I sell experiences, I sell software. I sell a unit of a thing. In this particular case, the marketing projects that I sell typically cost about $25,000. Jobs, engagements. I incur direct costs associated with generating that revenue of $10,000. My profit on that project is $15,000, or in general, my profit is $15,000. As a percentage of the revenue that I generate 60% margin on that project, otherwise known as contribution margin. You may think this is obvious and somewhat simplistic. It is so hard for many companies to get this data. Why is it hard to get this data? Because the architecture of how companies set up their chart of accounts and manage their inflows and outflows does not accommodate knowing at a project level, am I or am I not profitable? Equinox business law has many clients. I'm sure some are profitable. I'm sure some aren't profitable. Do they know? They may, but they have to be invested in wanting to understand this. And why does it matter? Because this is unit economics. This, by the way, is what investors invest in when they invest in a business. This is what a business owner cares most about when they build their business? The thing that I sell, I have to add value to it by incurring some costs in order to get the product delivered or experience delivered to my customer, and it is either profitable or it isn't. Now, let's roll this up for a second, right? So I told you contribute, the definition of my profit on a project, otherwise known as contribution. Simplifying a little bit here for this discussion. So let's say I sell 50 of these a year. I sell 50 of these projects. It would reason, right? The amount of revenue that I generate is 1.25 million. And if I multiply 50 times 10,000, I incur direct costs of 500,000, otherwise known as cost of goods sold. And in order for me to service that, I have overhead. I've got salespeople. I want to pay myself. I rent a building where we come to work, or used to come to work, but I incur some overhead, right? And this is the income that I generate before taxes. Okay. Most of us analyze our income statement at that level of, this is the income that I generate before taxes. But what we lose, and this is very important, unfortunately, right? What we lose is the understanding of our unit economic model. Is how profitable am I at that project or experience level? But irrespective of that, I want you to just appreciate what I really am showing you here in plain English, KISS, keep it simple, stupid, 7th grade speak, right? This is really an income statement. Revenue, cost of sales, margin, overhead, profit. Nothing new. It's pretty good business, I think. Okay, but now let's talk cash. Okay, remember how much revenue I generated? Generated 1.25 million in revenue. But I have outstanding invoices to the tune of $250,000, meaning I performed the work, I generated the revenue, but I haven't been paid for $250,000 of it. And there's a little bit of math to calculate something we call DSOs, or days sales outstanding. And the way to look at that is, I'm so not going to do that. I will follow up with the simple math on this in the show notes after this call of how I calculated 73. Just believe it right now. But on average, it takes me 73 days to collect after I bill. So I perform services and I actually incur costs, but I don't get paid for 73 days. Okay, it's just like it's a yellow light, maybe a red light, possibly. Okay, so it takes me 73 days. I got 250,000. I'm still trying to collect. Remember how much I incurred in direct costs? $500,000 in those direct costs. Well, I still owe vendors for bills that I haven't paid. Good and bad, right? Like I owe vendors. I want to pay my vendors, but the longer I can wait to pay my vendors, the longer I keep my cash, right? We get that concept. So even though I incur these costs of 500, I wait on average, and I'll provide you with this calculation in the show notes, X days or 18 days to pay on average. So in total, right, I don't get paid for 73 days. On average, I don't pay out my vendors for 18 days. I have this cash conversion cycle. It takes me 55 days, 73 minus 18. Right, 55 days to go from performing a service to actually reconciling all of the dollars. And that time has an impact on cash flow. Like right here. Remember how much profit I generated? $300,000. But the cash that I received needs to be adjusted by the money that hasn't yet exchanged hands. Or I'm sorry, the profit that I recognize needs to be adjusted by the cash that I haven't received or hasn't changed hands. And that's 225,000, right? I'm out the 250 because I haven't received it yet, but I also haven't paid that $25,000 of the total of 500. So the cash I generate here is only 75,000. So in this year of generating 1.25 million in revenue, I had a profit of 300,000, like awesome, but I only generated 75,000 in cash. Difference between cash versus profit. I don't need you to become a master in the calculations. I need you to become a master in asking the question. Why and how can we improve? So there's certainly some things I could do, right? I could increase the price. So let's talk about improvement now, right? Great. Knowledge is power, embrace reality and deal with it. So what are some questions you might ask? I might say, well, I could increase the pricing of things that I sell, right? I could hopefully move my projects up from 25,000 to something more, maybe. What will that affect? Well, it'll certainly improve my profit and my cash. I could sell more projects. Okay, well, that'll improve profit and that'll improve cash. I could reduce the costs of delivering those things that I sell. Remember that $10,000 to generate that 25,000 project profit? Reduce my costs. Okay, it's worth asking the question. I could get paid faster from my customers. What if my customers paid me in 10 days, 20 days, 30 days, 40 days? I'm getting cash faster. Think what I could do with that cash. I could reinvest it back in the business. Maybe I have more cash to employ another individual. I could get paid faster. My cash flow is going to improve the faster I get paid. I could also delay paying my vendors, by the way. Hey, things are tight. Can we get on different terms? Rather than paying every 18 days, I'd like to pay you every 60 days or every 90 days. You may be successful, you may not. That'll have an impact on cash. I could reduce my overhead. We'll talk a little bit about that. So, let me popping back. Okay, so these are the application of levers or the questions to ask against Blast's business. Simple example. So now let's talk about controlling your levers. 5 primary levers. To summarize, increase prices, increase volume, reduce your cost of sales, improve your DSOs, remember days sales outstanding, how long it takes you to get paid, increase your days payable, the amount of time that you have to pay your vendors, or reduce your amount of inventory turnover. And I know I'm not using that as an example here. Some of you probably do have inventory, some of you probably do not. To the extent that you have inventory, the longer that you're holding inventory that is not converting to cash, the more you have dollars sitting on your shelves or in your warehouse. The last one is I could reduce overhead. So let's talk a little bit about each. The pricing lever considerations, questions to ask, questions I'd ask my team. Can we actually withstand a price increase? What's going on in the marketplace? Have we done any good customer development or competitive analysis to understand where our pricing stacks up relative to others? What is the sensitivity or what we call elasticity of demand for the thing that we sell, and how sensitive are our customers to changes in price? Have we even raised our prices as costs have risen? It's so common. I mean, I think we do it too at Stride. Our costs go up. We put more resources against providing the service, but we don't have a method or a systematic way of passing on price increases as our costs have risen. Something to ask. Is there additional value that we can deliver and layer on to the project, that $25,000 project that allows us to raise price but may be high margin? Warranties, as an example, are a good example of that. Warranties, I'm sure some of you buy warranties, like at Best Buy, like that's huge profit margin. Can you eliminate low-priced offerings? Remember, you have a certain amount of resources that you're putting against selling services and products. Are there lower priced offerings that you could otherwise deploy your team and resources to higher value activities, but for whatever reason, you're like, yeah, we do that. We've always done it. I don't know why we still do it, but we do. Be critical. Great time to be critical, self-critical right now. Changing prices is the biggest impact on profit and cash. Price increases is the biggest impact that you could have on profit and cash. You can also increase volume, right? Are there sales channels that we could open up, that we could tap into? Are there new geographies that we could pursue? Great example of sales channels. We have a wonderful client, Avital Tours, that does gourmet food tours around San Francisco and other major cities. Well, tours plus restaurants equals like not a lot of activity right now. So they wrote this amazing piece where they Avital talked about how she pivoted her business in 5 days. That was, I think, written up in the New York Times or New Yorker. So proud, because they moved entirely virtual to serve employers, to have these culture events and workshops, to do like virtual cocktail making, and they're figuring it out. Right? So how do we think about a different way to deliver the thing that we offer? Could we increase our products or services? Are there things that the market is asking for us today that we either put on the back burner, which I call the parking lot, important, not now, interesting, not now, that it makes sense to revisit and say, we talked about this, but there wasn't an impetus for it because everything was kind of going okay. Can we make a change? And can we accelerate our sales close process, right? Accelerating our sales close process, look at your sales cycle of how quickly you're moving from prospect through your various sales stages. And are there ways to accelerate your path to close, getting more volume into the system over that same period of time? No part of your business is immune when you start asking these questions and figuring out how are we going to operationalize it. Let's talk about COGS, cost of goods sold. Cost of goods sold. Could we improve productivity of our direct labor? I was on a call yesterday with a prospective client who actually runs a marketing services firm, and he does not and has never tracked the time and the utilization of his team. So he doesn't really know necessarily how productive or unproductive his labor is against particular jobs or services. That's a missed opportunity. It doesn't come without some complexity, right? Thinking about, okay, how do I track time? But if I can improve productivity of my direct labor, giving them more tools, better systems, better process, I either A, may not need as much direct labor cost, or I can support more revenue. This is code, by the way, for DLER, direct labor efficiency ratio, direct labor efficiency ratio. Really, the only way to calculate direct labor efficiency ratio is when your bookkeeping or accounting firm architects your chart of accounts in a way that isolates the labor that you put against direct revenue from the labor that you put against overhead. So architecting your chart of accounts and how you segment out your costs is what will allow you to assess, is my labor productive or isn't it? Can I reduce direct cost inputs like materials or labor? Let's talk about the cash cycle. Cash cycle considerations. Remember the cash cycle, how quickly I get paid versus how quickly I have to pay out. Right? I'd love to accelerate the time to get paid for sure. Well, I could give discounts for getting paid early, right? So you've heard the concept, right? 210 net 30, 2% discount customer if you pay me within 10 days, otherwise your bill's due in 30 days. What other discounts could you provide to incent early payment? It also helps to think about negotiating contracts that stipulate payment terms inside of the contract itself. And what you can do by contracting terms inside of the contract is sometimes avoid having to send out a recurring invoice, and you just get put on that recurring payment from your customer. Hey, it's already contracted, so We don't have to deal with the friction of invoicing and waiting to get paid. It's just how it is. And obviously, number 3, collections follow-up. When the CEO of the company is the one doing collections follow-up, by the way, they lose power in the relationship. It is a signal that I do not believe we as business owners or business executives want to put off. You have an accounting department, or pretend that you have an accounting department, right? Strive says we're your accounting department. Put that off so that somebody else can be responsible for doing the collections, and they can be a little bit of the bad cop, and they can be a little bit annoying. Not so annoying as you're going to lose the customer, but if you feel like as the CEO, you're the one calling and asking for payment, there's an inequity in the power dynamic of the relationship, which has some, I believe, some negative behavioral economic consequences. You can negotiate to pay vendors later, right? Hey, revise terms. Hey, we're in a particular spot. There are certain vendors that are probably more able to cushion or buffer delayed terms, especially if you're an important customer for them, and renegotiate. On the overhead side, right, this is where we all tend to get paid if we're non-producers directly against the revenue. Well, we can certainly reduce discretionary spending. One of the ways that you could do that is run a vendor by detail report in QuickBooks Online. Vendor by detail will give you the ability to systematically go through all of your vendors, review them, ask questions, determine where changes or modifications could be made. We did this recently and ended up eliminating a lot of software costs and licenses that we simply didn't even need anymore, even forgot that we had. So what, that added right to maybe $3,000 a month. I mean, that's real. But we tend to get lazy when the sun is shining. And when the sun's not shining, as it's not today in Seattle, as many of you know, digging in here is really valuable. And it also shows your discipline, right? Your discipline, your rigor. You can reduce non-producer overhead. If your overhead isn't associated with producing, then maybe it's not core to being inside the 4 walls or virtual 4 walls of your business. I like to say, outsource everything that is not producing. Producing, right? Selling, servicing, the thing that is uniquely yours to sell and own that's intellectual property, right? Like you own that. But everything else, to the extent that you can make it more variable cost or not burdening your fixed overhead, is a great, great idea. And I think we're in a moment where that's being acknowledged and considered quite a bit more than it ever has, because we can be having this conversation today. We're virtual, we're productive, we're effective, tools are in the cloud, people can access information from a lot of different places, that the light bulb has gone off for many companies to rethink, maybe I can approach this different. Maybe I didn't need 6,000 square feet. Maybe I didn't need an in-house team to do X, Y, Z, and I could outsource that by leveraging contractors and outsourcing. You can also think about restructuring commitments. So if you have equipment financing or rent, going back to those partners and proposing and recommending with conviction and confidence a term or revised term that still creates a win for all. The idea is not to try to get something at zero sum and have them give something up and you lose the integrity of your relationship. Win for all, by the way, is restructuring a commitment and saying, hey, like, I want you to feel good about this too, and I need to feel good about this. Is there a way we can put this together where my goals and objectives match your goals and objectives? So let's talk about some tools to take action. I would love a gift. A gift would be for you to consider 3 actions that you could take today to improve your cash flow or profit. I gave you a whole bunch of ideas. Some of them are relevant for your business. Some of them you're probably going to say, we never do that. We can never do that right now. Okay. 3. Write down 3. Build a plan. Build a plan up front before you execute on that plan and start running and saying, okay, we're going to do this. Think through the implications operationally of making a decision and its consequences or impact flowing through the organization. Identify an owner. We often get frustrated, ourselves too, by the way, when we have a great idea, but there isn't somebody who says, I own this, and I am going to see its execution through to completion. That doesn't mean, by the way, that an owner does everything. It means that they're responsible for monitoring and measuring the success of that intended plan. Execute the plan, and we live in a learning world. Learn and iterate. This is all about continuing to create. This is all about keeping at the front of your brain, I'm innovating in my product or service, and I'm focused on growth, right? I'm learning, I'm iterating, I'm changing. Some good hygiene tools and strategies. Build and manage a cash flow forecast. Certainly if you're Accrual, you're not going to see cash very easily. So build and manage a cash flow forecast. Some of you, it's very, very sensitive. So it might be daily, it might be weekly, it might be monthly. There are a few ways to do it. There's some very simple Excel cash flow forecasting tools out there, and I'm happy to share those in the show notes with Michelle. There's an app called Float, www.floatapp.com, which we found to be pretty effective and we're experimenting with for a few clients. There's also a cash flow management app called Cashflow Frog. So what those apps help you do, those software applications, is help manage the timing of inflows and outflows at a pretty detailed level to give you more confidence of, okay, what's our cash position likely to be next week? Oh, I have payroll coming up. Oh, I have to pay this vendor. Oh, I expect that purchase order to finally get paid. Implement good bookkeeping rigor and discipline. Of course I'm going to say this, right? Accurate, timely financials. Super important in order for you as an owner to then stand on the shoulders of that information to do the kind of analysis we were talking about, vendor analysis by detail, looking at your trends. Employ some tools to streamline your processes that, by the way, have the effect of reducing overhead, because there's just a lot of efficiency with these tools. So Bill.com for vendor management, we really like. We're using Divvy a lot more today for managing employee expenses. It's like virtual credit cards for employees that are out in the field. But what's cool about Divvy is you see immediately when they incur certain charges, and you don't have to wait for their expense reports to come back. Because, by the way, waiting for expense reports to come back, sometimes you're surprised, like, oh my gosh, I did not expect that. Divvy helps alleviate it. Expensify is another good tool for credit card management. We also like using T-sheets for employee time tracking. So if you bill jobs against time and you want to know efficiency, T-sheets integrates very well with QuickBooks Online. Transparency tools are really important too. So one of the areas where we've invested is working to bring forth data visualization to our clients so that they can see real time trends in the key metrics, financial metrics they want to manage, and not be left waiting or guessing till like the end of the month. They have real-time access to their portal and can see variations. And again, it's about asking questions. A lot of us aren't like experts in finance accounting. Certainly close our eyes when we get like these 100-line spreadsheets of financials and don't really know where to look. We help you figure out where to look. So let's just talk about the end result for Blast, power of levers. So if Blast was to do these things, right, if they could increase their prices by 10%, it would have an impact on profit and cash flow. Now you might be saying, well, why isn't cash flow the same as profit when you increase prices? Well, remember, by increasing prices, they still have to wait to get paid. Remember, they were on that 73 days of waiting to get paid. So cash flow isn't exactly going to equal profit. I think I've convinced you of that already without going into detail into all the calculations. But what I did here, just as a fun model, is I said, okay, well, if we increase the volume 5%, reduce our cost of sales 5%, we reduced our overhead 10%, we improved our days sales outstanding, we improved our days payable. Just believe me here with the numbers. I'm happy, by the way, to share the detailed spreadsheet of how these got calculated, because you're like, I want to do this too. Awesome. But the net result is a total increase of $146,000 over where they were originally, right? Over that 300, and cash flow is $143,000 increase. So small changes, pretty material impact for the company. So let me just summarize what just happened to you. We talked about cash versus accrual. Know it, understand it. We talked about unit economics, the gold. When you talk about your unit economics, you evidence a level of control and mastery and desire in the, over my right shoulder, in the machine of your business that really matters. I referenced KISS a couple times. Keep it simple, stupid. Let's not try to be too smart about this. I mean, yes, be smart about this. Like, let's not try to be like too like sophisticated with terminology and make it more confusing than it needs to be. Levers. Ask the questions. What are the questions we can ask? Tools. There are some planning and execution tools that are available out there that many companies aren't using today that I think could significantly streamline processes and systems. And action is now. In a world of scarcity, in a world of unknown, people want to think about what can I do in the next 30 days, not what I can do in the next 6 months. I am but one focused webinar that Equinox is putting on. There are more in the mix that are coming after me. Michelle, do you want to highlight what's coming up so people can plan accordingly?
Sure thing, and then we'll address, we have a couple of questions here, so we'll do those after I go through this. So as I mentioned at the beginning, the focus events we've been doing for over 10 years, we do them monthly. They used to be in person. We actually transitioned them online before the pandemic, but it turned out to be the right decision early on. So coming up for June, promoting a positive culture in a virtual workspace. We have all shifted somewhat to virtual. So how do we kind of keep the team together? In July, negotiating a fair commercial lease. There's a lot of discussion right now around how do we think about our leases. I had a client just earlier this week say, you know, should I be asking for rent abatement? Should it be longer term? What should I be doing? So that should be really topical for businesses trying to think about how to manage that. In August, revisiting your insurance, lessons learned. We've all kind of looked at how does insurance fit in here? Well, in a lot of cases it doesn't. So what have we learned and what can we do to be better positioned? And then program on complete and compliant customer facing contracts in September. When we send this recording out, you'll be able to see these and hyperlink to these different events as well as to our newsletter. So you can get updates on a regular basis.
Awesome. Great lineup.
So a couple of questions.
Great lineup.
A couple of questions for Russell.
Yeah, go ahead.
So a question from Givel. Do you recommend a person or company we can hire to help us with analysis of expenses that can be cut, such as direct labor, unit metrics? What do you have there for resources?
Yeah. Can you hear me okay? It said my internet connection's unstable. Oh, can you hear me?
Yeah, I can hear you now.
Hello? Okay,
yes.
Sorry about that. It said my connection was unstable. I know Javel. Hi, Javel. Yeah, so yes, there are individuals, and my recommendation is to go to an individual that's probably an independent contractor, not necessarily a firm, and I can help you, that will swoop in on an episodic basis and help you unlock some of those questions that you're asking, like on a project basis, so you can time box it. It's very clear what they're doing. They get in, they add value, and get out. I think that level of support is helpful and manageable. And I'm happy to provide some introductions and recommendations.
So Russell, I have a question as well.
What else?
You briefly mentioned individuals who maybe, can you hear me? I think we have a little delay.
Yes, I can hear you.
So you had mentioned individuals who might fall into both overhead and production. How do you recommend such as owners, for example, who are doing some production and some, sales, marketing, CEO type work? How do you break those out?
Yeah, I hate asking, can you hear me? But I'm asking.
I can hear you.
Can you hear me?
Yes.
Okay. Yeah. So you do an allocation, you split them out. I mean, it's not perfect because you're probably not time tracking, but if you're like, half my time is really spent on delivering the service and half my time is really spent on overhead, business development overhead, then allocate your comp 50-50. So it's a judgment call, but that's very reasonable to do. Reasonable to the point of don't let perfect be the enemy of good enough. But if you're a meaningful piece of that production expense line, direct cost, you should consider it.
Perfect. I don't see any other questions. Does anyone have any other questions? So what we'll do is for the participants, you will receive an email in the next day or so that has a link to the recording, the program notes that Russell had mentioned, as well as access to our events, links to our events, and links to our newsletter as well. So we really appreciate you all joining us this morning. Russell, thank you so much for taking the time to share this information. I know I took away not quite my full action plan, but the first steps toward my action plan. And I really look forward to working with my team to implement that. And again, Russell's available to you all if you have specific questions that you want to reach out to. And we look forward to seeing you next month.
Awesome. Thank you so much. Such a pleasure. Have a great day, everybody.